Hi, I'm Ronnie from Veloris Capital. Today I want to talk about the most underrated skill in investing, which is patience. The chart behind me shows compounding over 30 years. Compounding simply means your returns start earning returns of their own. Each year's gain joins your original money and that larger amount grows again. We assumed 10% a year here. That is roughly what the S&P 500 through the SPY fund has returned over the last 33 years with dividends reinvested. Our own figure is 10.86%. Now look at the shapes. $10,000 left alone grows to about 200,000. Add $500 every month, and the same 30 years end near 1.3 million. The first decade looks almost like a straight line. The final decade bends sharply upward. That bend is compounding at work. This is not opinion, it is arithmetic. So compounding rewards time, but it only helps if you stay invested. This chart shows how often the US market finished positive, depending on how long you held. We built it from daily SPY prices from 1993 to today. Over any single year, results are noisy. About 82% of those years finished positive, so roughly 1 year in 5 was negative. Stretch the window to 5 years, and nearly 85% were positive. Over 10 years, almost 92%. And every single 15-year and 20-year window in the data finished positive. That is the historical record, not a forecast. The lesson is not that markets always rise. They do not. The point is that a longer horizon gives compounding the room it needs. The costliest mistake new investors make is selling after a rough patch and stepping away. The numbers say staying invested is what pays. The SPY baseline is hard to beat, and most active strategies do not manage it. So how do we try? Our process rests on three pillars: the stock universe, the optimizer, and the risk overlay. The stock universe screens for structural quality. The optimizer then decides which qualified names to hold, not how big each position should be, because every position is equal weighted. The risk overlay is the part people ask about most. Every night, the system recalculates more than 20 risk indicators across markets and sets our equity exposure for the next day. It does not predict where prices go. It is time tested to limit how far we fall, not to call tops or bottoms. Think of it like a race. You need to know when to accelerate, and just as importantly, when to brake. Some months we will trail a sharp rally because the overlay has lowered exposure while markets look weak. We accept that trade-off because the strategy is built to outperform across years, not week to week. If you decide to copy us, we ask for one thing, and that is time. We suggest at least 12 months as a fair test. A single month is just noise. 12 months covers a full earning cycle, and it lets the risk overlay engage and step back at least once. If you choose to copy, eToro technically replicates our trades proportionally into your own account. You stay in control of your account at all times. Veloris Capital is run by two veterans with more than 40 years of combined experience, and we invest our own capital alongside copiers. We are data-driven, not gut-driven, and the process is built to compound across years. Past performance is not an indication of future results. Your capital is at risk. Thanks for watching, and give compounding the time it needs.